Agrawal joined just now. Raamdeo, good morning. Thank you for joining us. Let's get a reaction going on crude. I never thought in our living memory anyone will see a price of negative on oil, but that is what has happened last
Negative,
night.
yeah.
It is like saying that पानी पेट्रोल से ज़्यादा महंगा है, technically speaking. Now, what do you think will be the implications of that? Do you think this is going to cause a series of unwinding NPAs for oil producing nations, for oil producing companies, and for banks which have given loan to some of these oil infrastructure companies? Is that a bigger problem which we now need to fathom?
This is to some extent, of course, caused by COVID because there is a global collapse of 30-35% because of lockdown in consumption. But I think producers, despite seeing this fact, the consumption dropping, they kept on producing. I mean, there is some kind of a volume war rather than price war. And Saudi Arabia, Russia, even today they are producing full blast. So it's a very crazy kind of trade war when Corona is on and demand has collapsed. So basically, whatever is perishable and what cannot be inventorized, of that value is going down. Whether it is airline seats, I mean, right now oil is looking crazy, but airlines have gone literally bankrupt. So the prices of seats have become zero. Prices of hotel rooms have become zero. Prices of now oil, what you can't inventorize or nobody wanted to take delivery, that has become zero. So I think this is unprecedented kind of scene. We have never imagined, and the people who have lent money to them, to any one of them, and the employees, the economy altogether. I mean, and oil is, I mean, entire West Asia, Saudi Arabia, Abu Dhabi, or Nigeria, Iran, Iraq, all of them are dependent on that. So how this is going to, what is going to be the lasting impact has to be understood. And I don't know, I'm not competent to really, it's not positive, that much is for sure.
Now, in your PMS schemes and in your brokerage firm, you deal a lot with sovereign funds, largely funds which are run and managed by oil producing countries. They had a surplus and they were investing in global assets. Do you see that there could be a reversal there and that is going to cause more liquidity crisis?
I would think so, because a lot of sovereign wealth funds, particularly those who are Middle East housed, like say Kuwait or Kuwait, Abu Dhabi, Norway, Qatar. So all these funds, they are very large. I mean, they don't talk in billions, they only talk about trillions, half trillion, 1 trillion, quarter trillion. And definitely they have raised one round of money, which we saw the selling. And there was some respite for some time. I won't be surprised if they go for another round of selling any point of time to raise some more cash, because oil itself has lost value, and yet the economy has to go on. So how much they have sold, I don't know, but now markets are better. I'm quite sure they will come out to sell some more. So I would be looking forward to seeing their sellings happening.
So one should not rule out that we could reset the recent lows. I mean, do you think one should not assume that Indian stock markets are out of the jail?
Yes, I mean, going by my experience of last two, particularly 2000 collapse and 2008 collapse, I don't think this problem is sorted in 30 days. The problem itself is not sorted, and we don't know how long it will continue. And now every 1 week incremental is almost like a week, a month, or a year or a quarter, something like that. So cumulative damage, incremental cumulative damage is much deeper. So it's like after 4 punches, when you put the fifth punch, then and then sixth punch. So the impact of fifth and sixth punches are far higher than the first 4 punches. So that's how the world economy is taking it. And so longer it goes on, I think worse will be conditioned to again get up. But for whatever strange reason, the stock market perception is far more optimistic than reality on the ground. Now, our understanding is limited. We're all going by what we are seeing. I am seeing from here, and you are seeing sitting there in studio. So, but it doesn't seem to be, the problem seems to be far more deeper than what stock market reality is right now.
So classic Warren Buffett theory, buy fear, sell greed. Would you apply that theorem? Because right now, more than fear, there is panic. Do you think this classic way in which Buffett has always advocated one should buy fear, and if you buy fear, you will get rich eventually? Would you advocate that right now?
Yes, but in a very calibrated fashion, because these problems don't get over in 30, 40 days, and we are just about a month and a half or something like that. So my sense is right now just about explosion has happened in the house. There is a fire, there is a smoke, but nobody knows what is the extent of damage because the damaging is still on. So I think it is going to be far more prolonged, and hence. But then if you see that 7,500, 7,600 kind of index, that itself was about 38, 39% from the top. Now, can we go lower than that? I don't have any crystal gazing, but at least time-wise, I'm not very comfortable that we have got over the problem. But what has happened is that a lot of companies have fallen way above this 25, 27%. They have fallen 50%, 60%, 70% also. So in some companies, we are already seeing very deep value emerging from that. And that is what is important, to buy stocks way below the intrinsic value of the company. Now, whether the index is at 9,000 or 7,000, it doesn't matter so long as you are getting the stocks way below the intrinsic value. So for that, you have to know the stocks which you are targeting very, very well. So I would think that values are emerging across many sectors, many companies, and hence some amount of venturing out, 10 to 15% of your portfolio, you must keep doing. How long it will take, and you have to have a plan to deploy your money, maybe in 3 months or 6 months. I would say 6 months, and keep doing your some scheme, some staggered or SIP in those 6 months.
A lot of people we've interacted with, a lot of our viewers are saying, look, I'm not averse to buying equities, but I'm very clear that I do not want to deploy more of my net worth into equities. Now, whatever, let's say if I had a portfolio of 1 crore, that portfolio has already come down to 65 or 75 lakhs. So I'm left with this and I don't want to allocate more, but I'm ready to churn. I'm ready to throw out my losers and buy more gainers. What should one do who says, look, I want to remain invested, but I don't want to commit more? I mean, it's a natural question, which I'm sure your clients also must be asking you now.
Yeah. In fact, at our end, since we don't have any cash, we are fully deployed. So what you said is a practical situation. The persons who are having portfolio and they don't have any additional cash, or they don't have appetite to put out more cash into the portfolio. So obviously you can only optimize your portfolio. And what is happening is this is a very unique kind of problem where some 1/3 or 30-40% of the companies or businesses are not impacted at all. The businesses which are very, very essential in character to the human being, that is more or less intact. And as you become more discretionary, more luxury, I think the impact has been very, very intense. So, markets have also been smart in punishing the companies which are discretionary and very large ticket size. So those companies catering to that have been punished much more deeper. And of course, the leverage companies, apart from the business laws, on top of it, if you have leverage also, then it's like a so the companies which are leveraged and discretionary in character, they are punished much more. But the companies which are essential in character, they are punished less, or the balance sheet is unleveraged and essential in character. Now the issue is whether you should sell the safe companies and buy into the risk. At the risky moment, that would be, earlier for a HUL, you are getting, say, 2 shares of HDFC Bank. Today, for 1 HUL, you are getting 3 shares of HDFC Bank. Should you do the swap? So that is for the fund manager to figure out where exactly that swap is for from good company to good company just because of the market opportunity. So it's a very dynamic situation. But yes, to some extent, one has to do that. And that's an opportunity.
It's a great it's a great example. I'll just say it again. What Raamdeo ji is saying is that you need to perhaps understand that where relative valuation is agreeing. And a great example which he gave is that earlier for 2 shares of HDFC Bank you were getting HUL, now it's 3. Now it's very easy to figure out where the value in this market is. Now Raamdeo, everyone is telling us that go for large caps. Small companies will suffer. Mega caps will also, go for big companies because that's where visibility, brand, and balance sheet strength is. But for large companies to do well, the economy has to do well. Small companies have to also need to participate. So how would you refute or argue when everybody on the street is saying only buy HDFC Bank, only buy an HUL, don't buy a small bank, don't buy anything in the mid-cap space, everything will suffer. If everything will suffer and if handful of companies will only survive, then how will those handful of companies make money?
No. See, the point is, you have to separate out the corona problem and from the stock market. I mean, these are two different issues. Corona has come and it will go. And nobody knows whether it will be 6 months, 3 months, 1 year, I don't know. But it will go. That is the optimism with which I am talking. It will go. Now, once it is gone, say in this 2021, this entire year goes in fighting corona. But 21-22 starts on a clean note. So when the economy comes back on a clean note, you are not going to see birth of some 100 more new companies. In fact, there will be fewer companies on the back of which this economy is going to come back. We have seen many times, many crises all over the world. In India, the world finds way out. I mean, this is surmountable problem. Let me tell you. So it will surmount this problem. And when we come back, the economy will come back with the same great companies. So what is most important is to first survive. Why we are saying the large companies? Because typically large companies, they survive better than, because they have many options and even government is very supportive of a large company not dying than the small company dying. So very important. I mean, it is your understanding whether even a small franchise, if it is very, very safe, there is absolutely no issue. In fact, you will get a double whammy in the sense that you will get the discount of a smaller company and you are getting a fantastic franchise. But that is completely your individual understanding. But with the largeness, what happens is it is taken for granted that this large elephant is going to be stable even in a worst of the storm or longevated storm. So I think what people are saying is buy a company which will first survive and then grow in good time. That's the safer strategy in risky time.
First, revival later. Okay. I'll turn the attention to more specifics in terms of sectors where there is a problem and sectors where right now the casualty has not been there. So let's pick up points of distress. That's how investors look at. They look at points of distress and despair to find value. If your view is that things will normalize, and if it's not FY21, it is FY22, second half of FY22, would you be tempted to look at things like aviation, hotel, tourism? Because it's not that mankind will not travel. It is not that mankind will not go to cinema halls. But that's where some of these stocks, but some of these stocks are essentially trading way, way below the intrinsic values.
Yeah. So, Nico, one has to understand the intrinsic value of, say, like aviation. I personally became very, fascinated by, say, Indigo. When it got listed and we allocated and we bought, we made some money also. But the volatility, even while everything was fine, was so high, whether it is oil price, whether it is competition, whether it is regulation, whether it is, what kind of, what's happening to the traffic growth. So, I was very tired. So we kind of sold it as thinking that this is absolutely unmanageable within the portfolio. 5% or 7% of allocation in portfolio, you have to give 50-60% of the portfolio time. Your working time, because so much happening every day. So then we said, let's stay away from that. Lucky I was at least, I was at peace not having that. But now, having said that, now you have this collapse. Now you don't know when will the this flying start. Of course, flying will start, and flying is one of the most integral to the mankind, and it is a very, very but very perishable in character. And with the low oil prices, their economics will also improve. But the social distancing and whenever this lock-in can come, so I think their current financial position has weakened, and now markets will remain very apprehensive of this business model. So I'll be very surprised worldwide whether aviation can ever get the valuation they were getting before COVID, because the risk is permanently built into the mind of the market. And the markets are very, very smart. Market has, 10 elephants memory. They never forget the bad things of the management of the business. So I think the P multiple for a lot of these sectors have collapsed at least for next 5-7 years.
You bought into consumer stocks. I distinctly remember in 2009 when the GFC crisis happened. And then we've seen a big 10-year bull run in consumer names like Nestle, HUL, Asian Paints, some of your favorite stocks. Where do you see this kind of an value where you say, look, I may not make money this year, I may not make money in FY22, but I'm sure that in next 3-4 years, these are the compounders which I always wait. Because an investor like you, Mr. Agrawal, waits for a bear market because that's the time you always get value. So what would be your next big allocation idea for next couple of years?
Nikunj, as I said, we are fully allocated, and we are definitely making changes at the margin. Definitely. There is a movement. Portfolio turnover is very low, but still 5-7%, 10% of the portfolio going away from what is there right now to completely new idea. Yes, it is happening, but it is you don't know at this juncture, because just 2 months back you thought something is fantastic and you allocated 7%, and today you are saying that, okay, what I thought was wrong. So you are already shaken. So we have to be extremely careful. And what I'm trying to do is that I'm trying to actually reduce the number of stocks. So if I have 25 stocks in the portfolio, and if I don't like for some reason one stock, I will sell that, and instead of buying completely new stock, the one which I think has a better prospect in the years to come, that's what I will buy. So that will be my portfolio strategy. But coming back to very specific sectors, consumer is of course most preferred, because anything which is essential around consumer is very good. So I would do anything around consumer, even financials. Like yesterday we were having intense debate on insurance, because insurance is initially got hammered as much as banking, but they are fundamentally very, very different business. So banking is very levered up, and insurance is completely unlevered agency business. So I think if we get deeper value into insurance, probably we can increase the allocation by a few percentage. So like that, we have to go one by one, find here, there, because in any case, it's a matter of allocating 4-5% more, or somewhere we find very deep value. Then we can switch anything and go in there.
So let's talk about a pocket where everyone thought there would be a problem, and that was IT, because it's a manpower driven business. If you work from home, how will you complete your projects? But I was blown away with what TCS shared, that 95% of the people are working from home. Infosys has a number which says 90% of the people are working from home. Now IT companies are safe, they don't have a balance sheet risk. Dollar is helping them. Will IT become a good sector now?
Nikunj, I'm so impressed with the global IT and even our own IT. And right now, I'm on the screen with you and talking absolutely without any problem, sitting in Ambi Valley, Lonavala. So this is all technology, and I think we have undermined the power of technology in terms of valuation. The balance sheet is fantastic, margin is very good, cash flow conversion is very good. The growth outlook is somewhat subdued, but right now, in a very low interest rate environment, and if you have a very robust franchise with longevity, I think post all these events, and then what happens is, once you have working from home, then the possibility of scaling up of these companies would be much, much larger. So today, if they're working with say 200,000 people, and all of them are sitting in campuses, but they can do another 200,000 sitting at home and being complemented by 200,000 at the campuses. So I think the capital intensity can go down, and the scalability of the entire model can go up, and that is all on the back of technology. So I remain a little more positive on technology post-COVID.
We had Jim Rogers, Mr. Agrawal, just before you logged in. And he said, look, I'm an old man, but if I have to buy stocks for my children, I would buy food delivery companies, I would buy digital-based companies. He says, I don't understand these businesses, but I know demand of these digital services will go only higher. So in the post-COVID world, if you have to, let's say, understand that how can digital investing, digital, economy which is going to pick up, how would you invest in a digital dominated economy? Because that digital economy is coming, sir. We both know that. Would you buy a telecom company? Would you buy a stock like InfoEdge? Would you buy something like Jubilant Foodworks? What I'm trying to understand from you is that what is the best way to maximize on the digital explosion which will happen both in terms of supply side and also in terms of demand side?
Yeah, so see, in investing, one thing is very clear, Nikunj. You should not buy if you don't understand. Howsoever big guy you are, don't speculate in the future. That is never going to take us to right destination. Never we should speculate. We must buy what we understand. If digital economy is not beyond me, then I would rather give money to somebody else who's a young and who can do a better job. So that would be one. But coming back to what is my competence, say we understand telecom. So if by chance telecom is available, I mean, the entire world is today running because of the social distancing and all the offices closed. The whole network is only based on telecom. And so I think telecom companies are far more essential than we ever felt. And I think people might be willing to give up one breakfast for their 4G line. So I would think that telecom has gained immense importance in terms of essentiality and the importance of it. And second is that the competitive framework has completely changed from multiple players, 10, 15 players to just about 2.5 players now. So I think we are in a very interesting shape. And I would think that so that is the way to go about it. But very interesting, in technology companies, when I look at digital, I would rather go for the companies which have shown some stability in last 5-10 years. I mean, I will not buy a bundle of promises, but I will see some amount of like when we do in private equity, we are saying the companies which have made profit about 10 crores, because I don't know which business model will work, but we believe in the growth. So I believe in the growth of these companies, and the companies which have delivered solid profit after tax of some amount, those companies and those entrepreneurs are worth betting on.
When a crisis happens, Mr. Agrawal, we always say that we are in a scary situation. The definition of crisis is that event or those chain of events are something which we've not seen before. Because if we have seen before, the world would be prepared for it. When 9/11 happened, everyone thought it could lead to World War III. When 2008 happened, we thought that the global banking system will fail. Now that there is a challenge on healthcare, and because of lockdown, we think that world is going to collapse. But the definition of crisis, sir, is the fact that we've never seen these chain of events historically. So every time when crises have happened, how have you kept calm? And why should one right now ignore the short term for long term gratification? What are you telling yourself again and again? Would you like to share that experience with us?
Yeah, of course, any experience is worth sharing. But in my 35 years of investing, I still remember 92, we were a kid. I mean, it is too long back. And it was Harshad Mehta, and first time we saw money. So it didn't matter when it came and when it went. So, but what I have seen that there is a 3 times I have seen 65-70% correction in my portfolio. And you tend to be actually right at the center of a storm. I mean, at least my style is such that I actually end up becoming the center of the problem itself. In the sense that in 92, in Harshad Mehta time, I thought the banks are cheap. And I bought into the banks. I mean, my 70%, 60% of the portfolio was in banks. and the scam happened in the banks only. So the market collapsed 65%. The index went down by 50%, but I went down by 65%. In 2000, actually, I called the peak of the technology boom absolutely right. At the truth, I sold Infosys at that point of time at 11,000, and I was way ahead of anybody else in selling. But what we did immediately after 15-20% decline, we went and bought some useless company at a cheap price, which became actually zero. So all the, at the end of it, we lost money, and that again 100 became 30. Now, third time in 2008, again the story is different. Again, it expanded by 15 times. That 30 became 550, and then it collapsed. And this time the collapse was, I mean, we were knowing it is coming, and we just wanted the party to go on for some more time. But before you realize, the whole thing collapsed. So, you know, every time the story is different. But 50-60% collapse is given. You don't make money every time, and you cannot time it. I'm telling you, at the end of it, after 2 or 3 years, we'll realize the people who stayed in the market, they made maximum money than the guys who successfully timed the market. Just watch the guys who have successfully been sitting 10-20% or maybe even 50% in cash, how they will re-enter. I mean, their nightmare is every day they're thinking whether they should have re-entered or they should re-enter today. I think the entire energy will go in that. And then there'll be, of course, 1 or 2 winners of timing right, sell at the top and buy at the bottom. But it is humanly impossible. At least I am not competent to do it. And I have not come across anybody who has done it successfully on some kind of scale. So I have stopped doing that. I mean, I have reconciled with the fact I cannot time the market. Even if it is a big one, I cannot time the market. I have become fearless also. When I own companies unleveraged, in the sense that my own portfolio is not leveraged. If I have $100, I've bought stocks worth 99 and a half only. I don't have a stock of 101. So at best, it can go down by 60%. I'm mentally ready to go down 60% for whatever is the peak value. And in fact, I was in Bangalore 2 months back, and in one of the presentations, I said, it looks fourth chauथा बुलावा आ गया है. You know, fourth time calling has come, and we might look at some abnormal correction, and hence, in next 30 days, this happened. So, so you have to mentally get reconciled for a what about 20% or 22% kind of return we make. This is the price you pay, and this is the risk. I mean, nobody. It is called risk purely because you cannot fathom the why it is happening and when it is going to happen and what intensity will be. That's the definition of risk. And risk will find you wherever you are sitting, howsoever smart you are. Risk will catch you, and hence your portfolio will decline. And that is what is happening. And I'm mentally reconciled that, and that's why we keep saying quality companies, buy quality companies, because quality companies are good in good time and very good in bad time. And non-quality companies are good in good times, but superbly bad, and mostly they sink in bad time. So you have to survive. In equity market, the guy who survive every cycle are the guys who are going to be big winners. So that's what my thinking is, and hence I'm reconciled to deep corrections. It doesn't pain me.
Well, we've had a fascinating conversation today. So stay safe, and certainly hope to see much more of you going forward. Let's take a break. We've had it's been a bad start to the trade, but we've got two real, marquee investors, Jim Rogers and Raamdeo Agrawal. Doesn't get bigger than this. If you're a value investor or even if somebody's looking for a short-term opportunity, Jim's told you what to do, and Raamdeo's been telling us that what not to do in this kind of a market.